two, one. What's up, everyone? I'm looking at OKTA. Okay, I opened up a trade a couple days ago. Uh, you can see here that OKTA had an earnings report, massive volume spike, massive selling. It crossed down through its 200-day moving average, and I actually opened this trade the day after earnings, which usually you want to let earnings have. You don't want to trade around earnings because unless you know what you're doing. Um, I sort of go off historical patterns, and I look for I back test the historical patterns and see what type of results happened in the past, and see if we can trade based on that. So, for example, when OKTA crosses down through its 200-day moving average, historically, we've had a 6 wins and 1 loss with this specific diagonal strategy, and I'll show you how exactly I do this strategy. Basically, you buy a 50 delta call with a 60 day till expiration contract, and then you sell a 20 delta call with a 30-day expiration. And here there's no close, no technical close or open. So let's look at the options contracts for this. So like I said, I opened this a couple days ago. We chose for this contract, for this play, we chose the June 25th. So this is supposed to be the 30 days till expiration with a 20 delta call, and we're going to sell this. We're going to short this one. So a couple days ago, this was the 245. Let's see what the delta's at now. You can see the delta is, okay, down to 13, okay, because the stock has been moving the other direction. So we sold that and then combined that with the July 16th. We would have picked something closer to July 25th, but as you can see, the options contracts don't go out that far. So let's check out where our delta is now. We were at 55. Now we're at about 51. So that's where we're currently at. Something I did to adjust this trade as we're losing. As you can see, I opened this trade 2 or 3 days ago, and you can see one of my fears was we were going to pierce through this level of support right around 221, 223. And start heading down to this next level. So what I did is I went ahead and I opened an additional, I actually sold a call spread right at 230. I sold the 230, 240 call spread, and I can show you what my delta now is, my overall delta. So as you can see, my overall delta is 23. So I would say directionally, that's 28. There we go, beta delta. 23 isn't super directional, so I'm able to mitigate some risk with that. And I actually sold the June 11th contracts. Okay, so let's look at that in E-Trade. Let's see that in E-Trade. Okay. So let's add another leg, another 2 legs. We are going to select the June 11th. Sell to open the 230, buy to open 240. Now let's analyze. We got to flip this around. Sell open, buy to open. All right, cool. All right, so this is a little wacky, but and let's set this to the 11th, expiration to 11th. This is a little wacky, like I said. So basically, we've reduced our directional exposure, and as long as basically I'm selling that call spread, and if June 11th comes and we're below the 230 strike, we're gonna collect the entire premium of that, which was like $1.20. So we'll collect the entire premium, and that will reduce our directional exposure. But I'm going to keep holding on to OKTA until we get to the until we hit the June 25th expiration, which is the expiration of the short call that we initially bought. So that's it for OKTA. Yeah, just something I'm doing. I wasn't super confident going into this, just because, yeah, this is what I didn't like, how we were right on the support level and looked like we could have potential to break down through, especially after such poor earnings. So, but the back test results were sort of too good to ignore, and I said, I got to take a swing at this. So I'll let you guys know how this trade goes moving on. Take care. Bye bye.